Good morning. Welcome to Market Monday for September 29th, 2025. You've likely heard about the pending government shutdown tomorrow, actually, if Congress doesn't raise the debt ceiling. While politicians will undoubtedly gnash their teeth, let's remind ourselves of what that looks like for markets. Since 1975, we've had 21 shutdowns, and here's how long they've lasted. So government shutdowns are usually very short-lived. We can see here, more often than not, 1 month, 3 months, 6 months, and 1 year after the shutdown, the market has done pretty well. Looking 1 year out, the S&P 500 stock market has only been down 3 times. So really, other factors such as how's the economy doing and other general factors we talk about at Market Monday are really what drive market returns. So this is a major fade the news event. Speaking of market performance, we do talk about seasonality often here at Market Monday. In markets, history often rhymes. For example, here's the month of September, every September since 1985. We've talked about this a lot, grinding, then down in the second half of the month. Well, here's what 2025 has done. This is a caveat of seasonality and why we say there are no guarantees, just history. While September 2025 has certainly bucked the trend, let's zoom out a little. This is the full calendar year, just the last 10 years. So here's September, which we just looked at, and here's this year. Looking ahead, the last quarter of the year is often the best, historically speaking. So did we pull forward some of those gains into September? Time will tell. Perhaps one thing that spooked markets was Fed Chair Powell, during his press conference, stated stocks were fairly expensive. This made its way around the globe instantly, that the Fed chair was expressing a view on stocks. If you went beyond the headline, you would have seen that Powell explicitly stated he was not expressing a view about stock prices, and the Fed will stay focused on employment and inflation. In fact, this statement likely reads bullish, as he will not view a high stock market as having any impact on rate decisions. Fairly high by historic standards. Does he have a point? Looking down here, here's the current price to earnings or PE multiple. The higher the number, the more expensive stocks are. This table is split out into company size. The largest companies, called the mega caps, have a 31 PE, which is high by historical standards. As we see, it's in the 70th percentile here. As we go down in company size, for example, T-Mobile, the phone carrier, has a market cap of $268 billion, so it would be right in the middle of this category here, down to a 22 times multiple, and still high by historical standards, also around the 70th percentile. But going down to companies below 100 billion in size, we get to lower PEs. And the smallest companies, under 25 billion, are historically cheap. Of course, it always helps to look at the E part of the equation, earnings. And higher earnings reduce the PE ratio. Here's just the 7 largest companies, called the Mag 7, and it does appear earnings are growing and perhaps even supporting those high valuations. Have a great week.